So whole life and index universal life are two of the strongest cash value policies that exist. And I'm sure if you're watching this video, you're aware of that. But the question is, which one is better and how do they compare to each other? So instead of making this 3-hour long video about all the details and how they're different, I want to answer the two common questions I get more than anything else. And I've been doing this since 2007, and I can tell you these two questions I get asked more than anything else. And that is, one, how is the policy going to earn interest? How is it going to grow? And two, how is my cost of insurance calculated? And at the end of this video, I'll link two other videos, one to my IUL video, another to my whole life video, and that'll give you more details if that's where you want to go. But otherwise, this is going to cover the two most common questions I get when it comes to IUL versus the whole life policies. So when it comes to the cash value in a whole life policy, everything's built around guarantees. So you'll have a guaranteed column, and that's going to guarantee you somewhere between 2 to 4%, depending on the company, but it's going to be 2 to 4% guaranteed. Now, in addition to that guaranteed column, there's also a non-guaranteed column. Now, that non-guaranteed column is including dividends. So what dividends are they are a portion of the profits paid back to the policyholders. So, and not all whole life policies offer dividends, so it must be a participating policy. But if it's a participating policy, it's participating in dividends. So it will receive dividends every single year. So in most whole life companies, they've paid out dividends. The ones that do have paid out dividends for over 100 years. So it's not, even though it's non-guaranteed, it's pretty consistent. So you'll have your non-guaranteed column that's going to be somewhere between 5 to 6%. So it's important to understand that your non-guaranteed of 5 to 6 is not in addition to your guaranteed of 2 to 4. So let's just use 4. Instead of going 2 to 4, let's say it's 4%. And for the dividend, let's just assume it's 6%. So it's not like you're going to get 6% plus 4% net 10%. It doesn't work that way. The guarantee is 4%. The dividend is 6%. So all that means is that it took that 4% and added an additional 2% in dividend to give a total dividend of 6%. So it's the original 4% guaranteed plus the 2% added, which makes a dividend of 6%. So that's how the dividend rate works. So just know the dividend rate is going to be somewhere between 5 to 6%. So when it comes to your cost of insurance, your cost of insurance is going to be leveled out. So here's what I mean. So let's say a 30-year-old's cost of insurance is here, and by the time they get 90 years old, it's going to be up here. So what whole life does is say, okay, it's going to be here at 30, here at 90. So we're going to do an average and just pay that level throughout the life of the policy. So what that means is, yes, in your early years, you may be overpaying for cost of insurance, but in the later years, you may be underpaying for the cost of insurance. Now, it's important to understand your cost of insurance is not the same as your total premium paid, which is your payment into the policy, because when you're structuring these policies for cash value, you're overfunding the policy anyways. So let's say you're putting in $1,000 a month into the policy, your cost of insurance may be $100, or instead of $100, it may be $60. But just know the difference in that small change from it leveling out and paying over in the early years is not going to change what you're paying into the policy. So what you're paying to the policy is going to stay the same. It's just internally the cost is going to be leveled out. So you'll be overpaying early, underpaying later, and that's how they keep that payment level. So now when it comes to the cash value of the IUL or Index Universal Life, it's a little different because you have two different categories. One, you have a guaranteed column. So the guaranteed column is going to give you somewhere between 2 to 4% fixed. So you get 2 to 4% the same way you get in the guaranteed column of the whole life policy. So that's one. The difference is with whole life, you get your guaranteed and then some. Now with IUL, you don't get the guaranteed and then some. You have to choose the guaranteed and you're going to get the guaranteed only. So guaranteed can be one option, or you can get the index option. So if you choose the index option, you're not getting any of the guaranteed 2 to 4% at all. So with the index option, it still has a guarantee, but the guarantee is typically going to be 0%. So here's what I mean. They operate with a floor and a cap. The floor is going to be more of what's considered your worst case scenario, and the cap is going to be your best case scenario. So let's say this index has a floor of 0% and a cap of 10%. Here's what that means. That strategy is going to follow an index in the stock market. So let's say the S&P 500. So it's going to look at the S&P 500 and it's going to follow the S&P 500 with a floor and a cap. So that means if the S&P 500 does 5%, then you get 5% credit. It does 10%, you get 10% credit. If it does 15%, you still only get 10% credit because 10% was the cap. That's what you have to understand. Nothing above that is going to be credited towards your account because you have a cap of 10%. Very important to understand. Now on the flip side, you have the floor. Floor means if the market, if the S&P 500 did negative 20, so you'll never get a negative deduction based on the poor performance of the market. So in that situation where the market did negative 20, you'll get 0. So you're not gaining anything, but you're not losing anything either. So you'll always be between that 0 to 10% based on the performance of the market. Now with the IUL, there are more risk involved because it's following the market. Because if the market goes negative for the next 20, 30 years, you won't get any interest credits towards your cash value. So it's very important to understand that when you deal with IUL, there's more risk involved because it's flexible. Things can move. It's not guaranteed like whole life is because we don't know what the market's going to do. It could do 4, it could do 8. But if you believe the market's going to perform better than what the rates you can get in a whole life, then IUL may be a better fit for you. But if you feel like you like the guarantees of the whole life, then the whole life might be a better fit for you. So whole life is definitely going to be less risky than IUL because IUL follows the market and the market is not guaranteed, but at the same time you have potential to get higher rates of return based on the performance of that same market. So that's the index and how it works. So you can have a 10% cap, 0% floor. Following the market, you get the credit whatever the market does, whether it be 10, 8, 7, 4, 0. If there's a negative year, you're not going below 0. So that's the growth. Now on the cost of insurance side, IUL uses what's called an annual renewable term. From the example I gave, the 30-year-old, the cost is down here, but when they turn 90, it's going to be up here. So what IUL does is charge you based on the age you are. So it's going to be cheaper up front and more expensive as you get older. Now the downside from that would be, okay, I have to understand that it's going to be more expensive as I get older. But remember, you're overfunding the policy, so it's not like it's going to change your payment. So if their payment was $1,000 a month, it's not going to affect that $1,000 a month. That will still be your payment. Now the benefit is the cost of insurance is based on my current age, so it's going to be as cheap as possible. So the cost will be lower earlier, giving me more chance to accumulate cash value earlier. And as I get older, that cash value should have accumulated so it can help pay for the cost of insurance. So in both situations, your cash value is going to pay for the cost of insurance through accumulation. Just one levels it out. One says you're going to pay whatever your age is now, which is lower earlier and more later. So based on the cost, it depends on what floats your boat. Now with the IUL, it is flexible, so there's some things you can do on the back end because as the cost of insurance goes up over time, you can change your death benefit option, which can reduce the net amount of risk, which reduce the cost of the policy. That's just standard how it works. One's level, one's increasing, but you can adjust it to make it fit your needs. So I always say work with a strong agent that can show you the details if you are interested in IUL, but you want to see how that cost affects you in the later years, or if you're interested in the whole life policy and you want to make sure that that level of death benefit is not overinflated in the early years. If you need help with either strategy, there's a link in the description box. Click that, set up a consultation, and we'll help you figure out what's the best for you based on your goals, not what someone else wants to do, what you want to do based on your goals. Like always, I definitely appreciate you guys checking out the video. If you have a question or comment, leave it in the comment section. Like the video, subscribe to the channel, and I will see you in the next video.